I think the longer that this conflict has gone, we're at the 1 month mark and change, and it looks like the likelihood of a swift resolution, particularly when it comes to getting traffic back up to 100% on the strait, that possibility is really narrowed.
In this week's episode of The Market Moment, we are joined by Stephanie Aliaga with J.P. Morgan Asset Management. Stephanie is not a client of our firm, and her appearance on this podcast is not intended as an endorsement of our services. No compensation has been provided for her participation. All thoughts and opinions shared in this recording belong to the participants. This episode is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Good morning, everyone, and welcome to The Market Moment. I'm Lee Mackey alongside John Martfield this morning.
Morning.
How are you?
Excellent.
Good. Well, as they say on the news shows, I'm Lee Mackey. This is John Martfield. Matt is away on assignment. So John is filling in. A secret assignment. John's filling in for Matt this morning. We have got a special guest with us on the Market Moment podcast, Stephanie Aliaga from J.P. Morgan. Stephanie, how are you?
I'm doing great. How are you all?
We're good. We've been very fortunate to have Stephanie on our podcast a couple times. This I think will mark the third time that she has been on it. I don't know if that's great for her, great for us, bad for her, but we love having her on. Our clients and the folks that listen, comment often that they wish we had more guests, and so
I think we should just let her do it every week. I think
she could be a
Do you have the time
host
to do this? Or just take over.
But no, we wanted to bring Stephanie back on. There is a lot going on in the world. Stephanie is a global market strategist with J.P. Morgan. She works out of their New York City office. And so, Stephanie, we're always excited to have you on our podcast. So let's just get started with kind of your expertise. Last week we were talking before we started this morning that both of us, for separate reasons, were out in the Bay Area. I had the privilege of spending a few days in Santa Clara, the heart of Silicon Valley, and we were just talking this morning. People were making fun of me that I got to drive or ride in a Waymo for the first time. Seen them on the roads, but this past week we rode in them, and it was different. Riding around in a car without a driver. But give us a 20,000 foot update on AI, where we're at. I mean, we're not going to really talk about from the market's perspective, but, kind of tell us what you're seeing. We're now getting ready to begin Q2 of 2026. I can't believe the year's going by that fast, but give us your thoughts on kind of where we are with the landscape of AI right now.
Yeah, that's amazing. It's only been 3.5 years since the launch of ChatGPT, and I feel like we talk about that moment as being this real milestone in now giving us this era of generative AI. And in such a short amount of time, we've seen such advancements. I mean, you see it now in not only SF, many other cities across the country, in Miami, in LA, in Phoenix, driverless cars growing in popularity. I think what's impressive there is not only the technology itself, how far it's come. We finally are at that moment of, increased potentially mass adoption of driverless cars, but also that consumer appetite has actually been quite solid. You felt safe enough in that car. Hopefully I did. I felt way safer than me driving, I'll say it. And it was, and they're going to pop up all over the country, but that's just one embodiment of it. The other day I was just taking the subway to work on my normal commute, and I was reading the ads, and I was just like, sometimes it feels like we're living in a sci-fi movie. There's an AI ad everywhere, one about like an AI friend that you can have. And I'm like, that's a little too ahead of its time, Yeah. There's others, like every like even image I can just clearly tell is AI generated, So there's that. There's obviously the fact that we're in a market that is increasingly dependent on AI, and for good reason. I think going to where we are in the markets right now, we are in this period of digestion around what has been a real inflection point for agentic AI. What does that mean? AI models that can now actually do things, that you can give them a task and depend on them to run and execute that task on its own. And that is a real shift from the browser-based LLMs that we had gotten more accustomed to using, and many of us are still using to this day. But what we're seeing with the advent of tools like Claude Code, Codex, and many of these other applications that are now spawning from it is that AI is automated coding. And when we automate code, we open the doors to creating all sorts of things digitally, because every device that we use digitally is ultimately built by lines and lines and lines of code. And we've always relied on software engineers, people with the know-how of building code and modifying code to create these digital systems for us, and we no longer need that. So we're in this digestion phase of what does that mean for software companies that may be dependent on that application layer as the moat, but what does that also mean for any of us, any other company in the market to harness this technology, a technology that has very clearly shown its ability to be quite effective at enhancing productivity, enhancing the quality of services, and reducing the barriers to entry for all sorts of things.
Something you said brought up a question I have. And of course, last week, the big news out in Silicon Valley was the lawsuit, the judgment against Facebook or Meta. And we've learned, years ago, the damages that some of social media existed that may have been ignored, may not have been ignored, and now the companies are paying for it. We now know about the guardrails that probably should have been in place with social media. What are some of the concerns that you have with this warp speed that is occurring with artificial intelligence? And are there going to be guardrails put in place? Are AI companies learning from social media's, mistakes of the past?
Yeah, you hope so, right?
Yeah.
I think the reality is, regulation is a hard thing to count on. We're just now barely really clamping down on some of those real risks that social media poses to mental health, to young children. And how long have we all been using things like Facebook and Instagram?
Sure.
It's been, well over a decade. Will it take that long for AI? I don't know, but we'll likely need to see a lot more evidence of the impacts once they come to fruition a bit more. I think in the near term, what we can lean on a bit more are a few things. One, companies themselves have risk protocol when it comes to using AI. And one of the real underappreciated risks here is even though AI is incredibly capable, it's still very prone to mistakes. In fact, we look at this data in our AI hub, which I can share after this, where we look at hallucination rates across the frontier AI models. They range from 26% to 80%. Some of the most capable models, like Claude's Opus 4.6, even the premium version, has a hallucination rate of 60%. That doesn't mean that this model isn't well capable. It doesn't mean that it can, that you can bring that 60% down, but it does mean that if you're not well trained at how to orchestrate these models, how to think about the ways that you're deploying them in your business to forecast supply chain considerations, to forecast risk, to forecast who you should lend to, if you're not really mindful about that risk, you're going to be making a lot of mistakes. So the risk then for the company is that it's them on the line. It's their margin on the line. It's their risk of being a lawsuit on the line, or the, whoever is like going up to court and is using like fabricated court cases, right? Those examples of it's your career on the line. So I think in some ways, the risk of that will shape behavior a little bit of like how we're using it, how quickly we adopt it. And then otherwise, I mean, I do think social preferences, like social backlash, what do we agree to? What do we, I think what was really interesting was to see how app downloads tracked following all of the fanfare around the Pentagon decision to mark Claude as I forget the exact term that they used, but some kind of national risk, right? Because they denied full unilateral control to the Department of War using these models. But what you found was the public didn't like that. They actually really liked what Claude did and sticking up for some values. And you see that in the behavior underneath the hood. So I think it'll be really interesting to see if that's enough and how that continues to shape the market and the leadership around these AI services.
Yeah. A 60% hallucination rate's large. I thought John's hallucination rate of 50% was high, but,
I'm glad I'm like right in the middle.
Apparently can go even higher. Did you have a question?
I just have a question on the global market piece of AI and how the U.S. has positioned itself. And are we in danger of losing the race to China, Europe, anywhere else? Are we the leader as we think we are, or are there and when I say threats, like threats as in somewhere out there trying to take over the world domination of not just the U.S. tech companies and so on. But anyway, I'll stop there. I've said enough.
Yeah. I'll say, look, there's two considerations here. One, on the frontier, there is really no competitor to U.S. technology. No one is pushing the frontier when it comes to these model advancements to the rate that we are. And we also are leading the world when it comes to the deployment of AI into our businesses and even on the consumer front. So data on all counts is like quite favorable for the US. Not only are more of us raising our hands when someone asks us are using AI, but we're using it at a greater intensity as compared to many other countries, at least like large countries. However, the risk from China really comes on pricing power, pricing pressures. And China, for a long time, right, has shown its ability to replicate, to create something that is similar to what the US has, but at a fraction of the cost. And they're doing that same approach, that same strategy when it comes to large language models.
You're being nice.
The fact that their models are open source, so anyone can use them. And I saw an article from Bloomberg Tech last week that basically said a lot of those startups in Silicon Valley, they may not be that vocal about it, but they're plugging their applications into these Chinese models because it's significantly cheaper. And those models are pretty good. So I think there's that risk of when we think about what does model commoditization look like, that there could absolutely be that coming from China. I think there's also questions around China is trying to achieve far less dependency on foreign counterparts when it comes to chip production. But this is the hardest thing to achieve for anyone. I mean, the semiconductor chips that give us AI, that power these models, are the single most intensive sophisticated products that humankind's ever made.
Right.
What Taiwan Semi has achieved, what ASML has achieved, and all of the components and the expertise that it's sourced from around the world for decades. Chip wars is a phenomenal read for anyone. But China may not get to fully, offsetting dependency, but they may get close. And I think what that means for competitive pressures across the supply chain, what that means for China's own confidence to do anything around Taiwan eventually, right? Yeah. I think that's a risk. But otherwise, I think it's just this question of pricing power. But the last thing I'll say is, look, China has obviously this long track record of replicating things. They've built a real manufacturing powerhouse. However, where do all of the profits go? Where have they historically gone? They've always gone to the US tech companies. And it's largely because we know how to offshore certain types of production that the US has been the belle of the ball for so long.
Good.
It is fascinating. And to your point, Stephanie, about the ads, driving around the Bay Area, last week, I bet you 90% of the billboards were AI.
Oh yeah,
Every company, yes, it was my wife was commenting, just you don't see normal advertising out there. Everything is AI centric. AI, we could talk about that for hours. We'll probably have you back on in a few months to continue talking about it. But let's talk about something that obviously is the elephant in the room. The Middle East conflict, what's going on there. Woke up this morning to the news that, the average price of, a gallon of gas topped $4 for the first time in a few years. Give us your sentiments. Give us your thoughts on, what is this doing to the U.S. economy, to the world economy? Have we reached a point where we need to be, pretty cautious, or are we still in that, if it ends in the next week or so, we're going to be fine standpoint?
Yeah. So markets were really singing that song that you just described. Like, it's going to wrap up pretty soon, and then all's going to be fine. The U.S. is insulated, and the impact on earnings and growth should be pretty muted. I think the longer that this conflict has gone, we're at the 1 month mark and change, and it looks like the likelihood of a swift resolution, particularly when it comes to getting traffic back up to 100% on the Strait, that possibility is really narrowed. And I think even when we do see some diplomacy reached, which there's a big uncertainty as to when that's going to happen, right? There's already been now some damage when it comes to demand destruction, when it comes to suppliers that now have had to cut production because they just can't store all of the barrels in reserves because they're not able to ship anything out. So now I think we're looking at a longer tail of these like price pressure, supply chain constraints from the Strait. But of course, the magnitude of the risk here remains, inextricably tied to when we do see some diplomacy reach. And that's the key here. I think the reality is, for the first few weeks of this conflict, I think markets maybe underappreciated how difficult it was going to be to get out of this, and that it wasn't just going to be the U.S. can't just decide, okay, we're done here, reopen things. They need Iran to commit to fostering an environment where people feel safe to travel on the Strait. And is Iran incentivized to do that, eventually? But they have a lot of asks, in order to achieve that, many of which the U.S. would feel strongly against supplying. So that's where we're at right now. And I think the difficulty for markets is, obviously now there's just this greater uncertainty. Markets hate uncertainty, There's also this threat around stagflation, right? Higher inflation, lower growth, because higher gas prices, right? They're pinching consumer wallets, particularly lower to middle income consumers that feel that pinch even more so. And now you have this likelihood that the Fed is not going to be cutting rates this year, at least so far as, this outlook persists. And so you've had the long end increase, and you've had a tightening in financial conditions. So this whole recipe is not good news for markets. Now, what is the good news? The good news is we always need to think about what's in the price and when do things start to begin to look a little attractive? Because I'll bring an analogy that I borrow from the great David Kelly, our chief global strategist. It's such a good one. It essentially is the sentiment that markets operate in a world of long summers and short winters. And when you operate in that world, when you're out in the Bay Area, when you're out in California, how many winter parkas do you have in your closet? Just a few. Yeah. Maybe one, maybe two, maybe none, right? But you have a lot of swimsuits, short sleeves, sunglasses, right? You have a lot of things that help you capitalize on those long summers. For investors, the same rings true, because the reality is there's always the winter, and these winters come by different storms. Right now we're in this geopolitical shock. You would think gold is helping you, but it's not. You would think bonds might be helping you, but it's not because of inflation, right? Now, what's helping you? It's energy stocks. It's some international players, like commodity exporters, and but there are other shocks that we experienced last year, right? DeepSeek, Liberation Day, they had their own basket of quality diversifiers. And the risk that investors run in environments like this is trying to optimize for these storms, for these winters, right? Yes, this is why we want to have a lot of different diversifiers in our toolkit. But let's not lose sight of the long summers, because after every storm, there is a long summer. And there are sometimes opportunities during moments like this to be even better positioned to capitalize on those long summers. That's what's going to be most important for your investments, for your portfolios over the long term, not trying to time have the duration or the severity of any given storm.
One thing that's
great points.
I wrote down short winters, long summers. That was great.
Love that.
One thing that I've gotten this question over the last few weeks is, well, I thought the U.S. was, oil independent. I thought we had enough to. Why is gas going up here? Why is the U.S. Brent crude price going up here? But I think we're learning that it's a global market. Yes, most of the oil that is coming through the Strait of Hormuz is going to parts of the world, the Far East, China. But it is a global market, and it does affect the price all around the world. A question? Did you have a question?
Well, I saw yesterday CEO of Delta Airlines was on, and he was talking about, they asked a question about Europe suggesting that some of the airlines in Europe have said they may have to stop flights because they're worried about running out of jet fuel. And I thought that was the first time I heard that. And I thought, well, the Strait of Hormuz is 20% of the world's oil, right? And we're starting to see some ships are going through. I think yesterday several big, ships made it through, and it's fine. But obviously it's not free flowing yet, and there's a lot of problems there, we know. But I heard that, and I'm like, how can that is that actually real? Is this something? And then the Delta CEO kind of dismissed that, like, nah, we're not. We are flying to Europe and back, and we're not. That's not in our conversations at this point. Have you heard any such things? Have you heard anything of that type of massive disruption from this conflict, or is this overreaction that we get a lot from, doomsday type of scenarios every time we have stuff like this happen?
I think it's related to Lee's question, because there is this big difference between what being, energy independent, right, might mean. And the reality is, for economies that are very dependent on imports from the Strait, Asian economies, Europe to a degree, right, what they run the risk of is not only higher prices, but supply shortages. And for the U.S., it's not really supply shortages, but we do feel the pinch from higher prices. Not everywhere, but for things like, fuel prices, absolutely. The good news is for other things like natural gas, that's a lot more domestic. And we haven't seen natural gas prices really increase, but European countries have seen liquefied natural gas, like imported natural gas, those prices have spiked. Right. So they're getting hit there, and they're getting hit on the oil front, right? And then there's this other concern of, like, what are some of the second order ramifications, right? Obviously, jet fuel very highly correlated to these prices. And then there's questions around transportation costs for anything that we're importing and buying, that moving higher. It's hard to size what that impact is going to look like. I think economies closest to the region are the most exposed. For the U.S., there's longer lead times to that exposure trickling over. Many U.S. major exporters and companies also are big multinationals that have supply chain diversification. But that is one of those risks that, investors are really, keeping an eye on. The longer that this persists, those ramifications begin to mount.
This morning I heard on the news that JetBlue announced that they were increasing their baggage fees to
offset.
Yep. Real quick, Stephanie, how long do we have before you really begin to see a passing on of these increased energy prices? to groceries, to toys,
Yeah.
to everything that we use on a daily basis. Are we seeing it already, or do we still have a little bit of runway left?
Mhm. It's tough to know. I think when we compare this to the global pandemic, okay, or even 2022, Russia, Ukraine, we were in an environment where consumer demand was far stronger. So the pandemic, obviously, you had pent up demand, you had excess savings from the pandemic, you had such a fast growing economy coming out of the pandemic. There were these supply chain constraints, but companies had the upper hand here and were able to pass those along to consumers. Even in 2022, we still had more stimulus trickling through the economy, and you also just had stronger job growth, higher rising wages, and so those energy prices were easier to pass through. Today, it's a very different environment, right? The consumer, is resilient, but they're definitely a lot more cost sensitive. Hiring has slowed down meaningfully. Wage growth has slowed down meaningfully. And the reality is for companies, they do have different levers that they can pull here, and they've been doing this with tariffs too. They don't immediately pass them on. There are other parts of the supply chain before it gets to consumers where some producers may take a bite of that cost versus others. And there are ways to adjust certain products, certain releases, the quality of things as well. So there's a lot of these different levers that they can pull that it's hard to really know. Is it like 3 months? Is it 6 months? Is it 8 months? I think where things get more problematic is if the price increase is so acute and it lasts for so long that there's really nothing that anyone can do, and that this has to be passed along to consumers. The good news is the hurdle to, I think, us reaching that point is still quite high and is still out to the future. And what we're dealing with right now is nothing near as acute as the pandemic was, or even really what Russia, Ukraine was. So I think, companies, particularly U.S. companies, have always amazed me at their agility in defending and expanding margins. And that pass through to consumer is not the only lever that they have to pull here.
It will be interesting, here in about 3 weeks when we begin, Q1 earnings, what the forecasts are, as we always look to see their guidance, especially if this conflict is still going on. And, the other thing that I was thinking about, and you mentioned it sort of earlier, was, we've been in this K economy where, the upper class seems to be doing okay. Yep. The lower middle class is struggling. And I think this just compounds that problem even more so. So, comments you have?
Well, I just on your point, there's a little stat here. 20% of earners are driving a luxury economy and are responsible for 63% of total spending. Now, that's a stat. Now, that goes right to your point of, and that could stop. I've always said for a lot of years that I worry about our younger economy, our 30 unders. Harder to find a home. We've increased the time frame where the average home buyer is now near 40, and it used to be a lot less. And we know the reasons for high prices and high interest rates now and so on. But I kind of worry about stuff like this when gas prices are starting to leak into the economy. We have potential pressures from higher prices maybe later, of that younger economy that drives the future being continued to have the thumb on them, where the luxury economy is supporting this overall economy, if that makes sense. When that runs out or slows down, it could be somewhat messy, but maybe I'm overthinking that. Please tell me I'm overthinking
that. Look, it's not a good thing for the economy in terms of like this risk of social unrest. I think you add on to like AI and like what AI is going to do. And there are absolutely, like, I think a lot of big questions. In terms of the K-shaped economy, there's two things here that could actually point to a bit of a narrowing. One, you have the one big beautiful bill and those tax refunds that are helping offset some of the pinch on the gas, pinch side. And otherwise, you also have even the top earners aren't really getting a lot of gains in their investment accounts this year. Markets are down.
Right.
So something that had likely been giving them more confidence to invest over the last few years, like that has definitely faded. So that could actually narrow things down. Not great for the economy and overall consumption, but maybe puts things on slightly more even ground. Beyond that, I would say on the AI front, there is a lot of fear out there about what AI is going to do for jobs. And we could have a whole other 30-minute episode on this. But I am by nature an optimist, but I will say I think the younger workers are getting a really bad rap here, where they are in such a unique position to really capitalize on this shift. Every college student these days, they know AI in and out. It is their core operating system.
You're right. Yeah.
And if they can use that ability, right, familiarity with new tools, the agility there, to be master problem solvers when they enter the workforce, I think they will be far more valuable for companies than some 30 to 40-year veterans that may be a little bit harder to evolve and learn new things. Like, they're going to depend on the younger people to really, bring the new ideas and show the ways. And the other thing I'll say, I think we may be at a dawn of entrepreneurship. The friction to starting a new company, to running with a business idea, to working on Claude Code over the weekend and putting a cool app on the App Store, maybe making some money from that, the friction to doing that has just collapsed. And you're seeing that in the data. Applications for new business formation is at its highest levels ever in the United States, outside of some pandemic distortions. And the number of mobile apps on the App Store are up over 70% year over year. So I think this is actually could be a very exciting time. Maybe these young workers aren't going to work for your big, multinational companies, but they decide, you know what, I'm going to try something out myself. And I think we really have to wait and see how that evolves.
You know what? I love that answer because I think that pushes people to do that too, by the way. If you're having a hard time getting the normal standard job, the idea of going to college 4 years, you go get a job, and that kind of, some of that has gone away. But the idea of entrepreneurship is driven from sometimes fear of other things not working out, but it also drives, and they're smarter. Like Lee and I, what you just said, Lee and I need to watch out. We're probably going to get fired soon, right? These young people are coming in much better. We're dinosaurs. But I love that answer. It makes me feel a lot better than I had thought before. So I appreciate that answer. Great.
Well, Stephanie, once again, thank you so much. Your comments are timely. They're well thought out, and they're quite educational. So I know that we learn every time that we get to listen to you. We know you're busy, and we want to honor your time commitments. But anyway, thank you so much for joining us on this week's podcast. For John, myself, and for Stephanie, we hope you have a great week.
Wonderful. Thank you so much.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.